Today, we are back again with another very important yet daunting news related to the stock market and inflation that you will be really interested to know about. After a hotter than expected inflation report shook financial markets around the world this week, Ray Dalio issued a harsh prognosis for stocks and the economy. What is causing the inflation to get higher and higher with every passing day, and why is the famous billionaire Ray Dalio concerned with that? We will cover it all today here on BBiz. So let's get straight into it. Ray Dalio has found his 50 years of worldwide investing that we are frequently astonished by events that have never occurred in our lifetimes. This prompted Bridgewater Associates co-chairman and co-chief investment officer to research 500 years of history, revealing trends that reappear decade after decade caused by economic swings, societal change, and world conflict. Such patterns assist him in identifying the larger challenges of the day. For example, he is currently worried about the impact of inflation as well as disputes, both inside and among countries, which can lead to redundancies and misuse of resources. Ray Dalio, who is an American billionaire financier and hedge fund manager, predicted that stocks will fall by roughly 20% when the U.S. Federal Reserve hikes interest rates strongly to combat inflation. Dalio, the owner of one of the world's largest hedge funds, Bridgewater Associates, issued a warning recently in a social media post, stating that an increase in interest rates in the United States from 2.25% to 4.5% will result in a 20% drop in equities values. He claimed that in the event of things, it will turn out that the interest rates will rise even more than before, a hike from 4.5% to 6%. According to him, if interest rates rise, other markets will fall, resulting in a worse economy. This will slow credit to private sector growth, which will slow private sector spending and, as a result, the economy. He also cautioned that the rises may be considerably higher due to potential economic problems in Europe and Asia, as well as droughts and floods around the world. Dalio's statement occurred on the same day when the U.S. statistics showed the country's consumer prices jumped sharply in August, sending stock markets lower on standards of another large interest rate hike. The Consumer Price Index rose 0.1% in August, after remaining unchanged the previous month. At that point, the All Items Index has risen 8.3% in the last 12 months, a tiny reduction from 8.5% in the previous 12-month period ending in July. For the year ended August, the energy index increased by 23.8%. Dalio said that an economic downturn was possible, citing experts' expectations that the Federal Reserve will increase its target short-term rate to 4.5% or higher as quickly as early next year. Dalio stated that a big turnaround in the economy is required, but that will not occur in the near future because cash and wealth levels are currently quite high. That is currently happening. For example, despite major weakening in interest rates and debt-dependent sectors like housing, consumption spending and employment remain relatively solid. He believes that the Federal Reserve's planned interest rate increase to 4.5% will have major implications for the stock market and the economy. Dalio pointed out that rising interest rates will have a negative impact on assets prices in two ways: the current value reduction rate and a drop in revenue generated by assets due to the weaker economy. He said when someone undertakes an investment, a single payment is made for future cash flows, and then, as a way to determine their worth, the present value of those for which you will apply a discount rate is being taken. That is what causes all boats to rise and fall together. So, where should shareholders seek refuge? Cash is certainly not the best option because inflation reduces its purchasing value. Dalio earlier stated that cash is trash, and he continues to believe this. Cash will still have a negative real value and will be a bad investment depending on how it contrasts to the others. let's have a glimpse at what DALIO'S hedge fund owns. Bridgewater held 6.75 million shares in Procter & Gamble at the finish of June. According to the fund's most recent 13F filing with the SEC, it was the largest position in DALIO'S holding at the time, with a market value of roughly $970 million. This should not be surprising. P&G is a conservative stock that can provide cash returns to investors in a variety of economic circumstances. P&G's board of directors declared a 5% annual hike in April, making the company's 66th continuous annual payout increase. The current annual dividend yield on the stock is 2.7%. It's simple to see how the corporation has been able to keep such a streak going. P&G is a well-known multinational with famous brands such as Bounty paper towels, Crest toothpaste, Gillette razor blades, and Tide detergent. These are items that people purchase on a regular basis, regardless of the state of the economy. There's another brand that comes under the influence of DALIO'S hedge funds, and that is Johnson & Johnson or J&J. Johnson & Johnson, with strong holdings in consumer health, medications, and medical equipment markets, has consistently given stable returns to investors across economic cycles. A number of business medical brands are household names, including Tylenol, Band-Aid, and Listerine. J&J has 29 items in all, each capable of producing over $1 billion in annual sales. Johnson & Johnson not only reports repeating annual earnings, but it also continuously increased them. Johnson & Johnson's estimated profits have climbed at an annual pace of 8% on an average during the last 20 years. In April, J&J declared its 60th straight annual dividend rise, and the stock now yields 2.7%. Bridgewater held 4.33 million shares of J&J as of June 30, valued at $769 million at the time, making the pharmaceutical company its second largest position. The iShares Core MSCI Emerging Markets ETF is Bridgewater's third biggest investment. IEMG monitors the MSCI Emerging Markets Investable Market Index while offering buyers easy access to companies in China, India, and Brazil. The exchange-traded fund owns almost 2,600 equities. Its largest interests are chip-making tycoon Taiwan Electronics Manufacturing, Chinese tech firms Tencent interests, and Indian multinational conglomerate Reliance Industries. Earlier this year, DALIO told another investing icon, Jeremy Grantham, that he is searching for countries with strong income and financial records that can survive the storm. Bridgewater had 15.31 million shares in IEMG, valued at $751 million at the end of the second quarter. So what are the parameters which Ray thinks would affect the global economy and inflation? Well, in Ray's opinion, these three things that are presently occurring are the production of massive amounts of loans and the sale of that debt, which is having an impact on inflation and everything else. The second factor is the number of internal disputes, with populism on the left and populism on the right, owing to the largest income and value inequities. That internal division is having a significant impact. The third factor is a great power clash, the rise of a great superpower in the form of China and the relative decline of the United States, as well as the confrontation between diverse forces, which we see represented in the Russian-Ukraine NATO war. In this statement, he said that it is just like a doctor who sees many patients who are not only diagnosed with a disease, but also the cause and effect of that disease is put into consideration too. In the same way, examining the last 500 years of cycles reveals not only patterns, but also cause-effect links. For example, there are several types of conflicts when there is a great power competition, and there is no such thing as an international court or a world justice system. And usually, there are economic wars, which are termed as sanctions. For example, in Japan, the same Japanese financial assets were frozen just as the US. and economic sanctions were also imposed that hampered oil imports. And these things are seen. It should be remembered that prior to World War II, due to economic conditions, there was populism of the left and populism of the right, which generated challenges that brought down 4 democratic nations during that period of time and turned them into dictatorial regimes. Here, he further stated that we are now entering an atmosphere with greater ideological or political resource allocation. As a result, you're seeing more difficulties like trade prohibitions and so on. You could notice foreign exchange controls and other issues relating to how those resources are allocated. Because of the increased violence, countries are becoming more independent and self-sufficient because they are concerned about being cut off in the event of a war. This has a significant negative influence on the economy's efficiency, contributing to inflation. So these 3 things working together and how they function together logically makes sense how the machine works, and we wouldn't have a complete awareness of that until we saw those historical patterns. Well, this is what Ray Dalio has to say about all of it, and to a point, we do believe that he's right. What do you think of that? Let us know about your views in the comments section below. Don't forget to hit that like and subscribe button. Thanks for watching. See you again soon in another video.